Glad to have all of you here. Give it just a few more moments for everyone to join in. All right, see more people joining now. So we'll get started. So very thankful to have Michael Pescatori here. Michael has been working with Home Office and um, showcasing the overlay services to us and to some of our advisors beforehand. Overlay services is something that we briefly touched on at the Advisor Summit back in Nashville. I'm very excited to bring this to our firm. A lot of you have had situations where you need to bring brokerage business or current APM advisory business onto the platform and transition it into managed money. And some of you have previously reached out and said, hey, do you have a tax service to help me transition everything over in a tax efficient way? Envestnet's overlay services actually assist us in transitioning those assets over for you. So I'm going to turn it over to Michael here in just a few moments, and he's going to cover the UMA tax overlay service, the FSP overlay service, and also the values overlay service. So Michael, the floor is yours. Have at it.
Great. Thank you very much, Marcus, and thank you everybody for attending today's informational session. I'm hoping what you'll learn out of this is that Envestnet has a systematic way for you to outsource your tax management capabilities to Envestnet, where we can really customize at scale, right? I don't think there's any more personal to our end clients than the taxation of their investments. So what we wanted to do today is to spend a few minutes just talking about how we think about managing for taxes, what the use case scenarios that we see typically in the marketplace, and how you can then use our service to help either transition your clients, get them a better after-tax return, or provide a higher level of service to your existing clients. So with that, let me go right into sharing my screen here. Give me 1 second. I'm going to share. And Marcus, you should be able to see that now. Is that correct?
I can see your screen. That's correct.
Great. Thank you very much. So when we think about managing for taxes in a client's portfolio, we know that clients are very concerned about tax management. And how do we know that? Well, there's actually a Cerulli goes out and they survey high net worth individuals, and what they find is that most high net worth individuals, their number one goal is to preserve their wealth, right? They've made their wealth. Now what they want to do is they want to make sure that they retain their wealth, right? They preserve it. Number two on the list was minimizing of taxes. And I look at that as though they are really tied right at the hip, right? Because if we can help minimize a client's taxation, what that does is that keeps more money in their pockets, and it allows the advisor to really provide a service to help them preserve and grow their wealth over the long term. We have, when we're talking about UMA tax management, we have two different services, really three services actually, that's available for clients in the UMA. The first is a tax overlay service. And what we're trying to do here is to really control the gains recognition in a client's portfolio. And we do that through a proprietary risk-based optimization engine. And all that's really stating is that what we want to do is we want to make sure that we're providing good decision-making at the client level that gives them better after-tax performance results without interfering with the money manager, right? Because what we don't want to do is we don't want to simply save at taxes at the expense of performance in the client's portfolio. Now, we're going to be able to actively tax manage both the equity SMA sleeves and the fund strategist portfolio sleeves within the UMA. Our second structure or second service that we have within the UMA is our values overlay. And this allows us to align a client's personal convictions with their investments. So I'll show you a little bit later, but we have multiple different screens that may be able to be applied to a client's portfolio that helps reduce exposure to certain types of asset classes or certain types of securities that the client may not want to own. The last service that we offer actually is to offer both the tax overlay and the values overlay in the single account structure, right? So you have either the ability to manage for taxes, to manage for values, or the third option is to have both values and overlay in the same client. Now, from our standpoint, you all are still responsible for asset allocation, investment selection in the UMA, whether that's SMAs, whether it's mutual funds, ETFs, those fund strategists. What your client will do is they'll benefit from the fact that the money managers are providing to us their intellectual capital. So that tells us what stocks they want to own and at what percentage weighting. And then what we're doing is we're really coordinating and consolidating the trading activities of those various different money managers. And here's just a quick illustration of that risk optimization that I talked about. When we're managing for either values or for tax in a client's portfolio, again, our first and foremost mandate is to always deliver the manager's returns. We don't want to get in the way of those managers' returns, but what we want to do is we want to make sure that we're making smart tax decisions at the client level. And I'll talk a little bit about how we think about that and some of the techniques that we use to manage at the client level. So this is just a quick example of an unconstrained model portfolio here where the SMA manager may provide us with 25 different individual securities. And let's say that your client has indicated they don't want to own tobacco stocks in their portfolio. Those may be represented by the two blue pieces of the pie here. By pulling those two out, the overall risk and the overall performance of the portfolio is going to change slightly from that unconstrained model. So what we do is we look to say, where can we redeploy the assets into other model positions that help reduce any what we call tracking error or performance deviation from that manager's model. So again, what we're trying to do is we're trying to provide a way to customize the client's portfolio, but do it in such a way that it's not being adversely affected from a performance standpoint. So we do have a couple requirements. You know, where we see the greatest value for tax managing clients' portfolios is with equity SMAs and fund strategist portfolios. So today, we need to have at least 50% of the portfolio allocated to those types of sleeves, managed product sleeves, because we want to make sure that we have enough leverage to pull to accurately tax manage the client's portfolio. On the value side, we need to have at least 50% allocated to either FSPs or equity SMAs, and there needs to be at least one equity SMA sleeve. Because when we're using the values overlay, we're screening out individual equities, and obviously we can't do that when it's a mutual fund or ETF. We can't screen those out from those pooled products. So let's just take a look at overlay services just for a minute. And if you think about the traditional SMA process, you know, most advisors use separately managed accounts because of the tax management capability. However, only about half of those clients receive any special type of tax treatment. And that historically has been on your shoulders as the advisor, typically to go in at year end, right around this time actually, and to do some year end tax loss harvesting. So that's a reactive approach to managing for taxes. But what we want to talk about is how we can be more proactive and use some reactive techniques at the same time. So inherent to every decision we make is that tight adherence to the manager's model portfolio, making sure we're not deviating too far away from that performance. The second thing we're going to do is we're going to make sure that every time we trade the account for equity and ETF trades, we're doing it at the tax lot level. Meaning if your client owns 4 different tax lots of, say, Tesla, and the manager wants to trim a position in Tesla, or trim Tesla rather, we're going to look to see account by account, which tax lot has the least amount of taxable gains to your end client. That can be different for each of your different clients because when they're buying into Tesla, they have their unique cost basis. The other thing that we want to make sure is this. We want to make sure that we try to reduce or eliminate as many of those short-term gains as possible, because for high net worth clients, those short-term gains could be taxed maybe up to 2 times that of your long-term capital gains, right? You have to look at what the client's marginal tax bracket is, what if they're hitting the 3.8% additional, plus the state taxes. So you could be paying, 2x that for short-term gains as long-term gains. So we're always going to want to make sure throughout the entire year, we have 0 net short-term gains in your client's portfolio, because that is the biggest way that we can add some alpha to the portfolio, is to reduce or eliminate those short-term gains and only take long-term gains. So I'm just going to talk for a few minutes about different techniques that we use to manage for taxes, because as I mentioned before, your techniques that you use today are primarily reactive from the standpoint of, hey, let's harvest losses at year end. But let's take an example where a manager wants to sell a position today, and client A has held that stock for 11 months and 2 weeks. Without tax overlay on the account, Envestnet would go in and sell that position, and your client may have a short-term capital gain. What we would look to do is, with tax overlay, we would look at that and say, you know what, maybe it makes more sense to hold the stock for additional 2 weeks to let it mature from a short-term gain to a long-term gain, and potentially reduce the client's tax bill on that single trade by 1/3 to 50%, right? The second technique we'll use for client B, maybe they've held the stock for 6 months and we can't hold it for an additional 6 months. Well, in that case, what we would do is we look to see if there's any losses that we may be able to harvest today to immediately offset that gain to make it a tax neutral event. So that would be an example of our gain loss matching, where we are immediately harvesting a loss. Now, the great part about doing this within the UMA is that it doesn't have to be in the same manager. So let's say that we're taking the gain in large cap value, but maybe the loss is in small cap growth. We're going to look throughout the client's entire portfolio to see where the losses exist, and we'll harvest those losses in order to reduce that taxable event. Now, client C, however, maybe they've held the stock for 6 months and there's no losses in the account. Well, if we were to take that short-term capital gain, we would then, from now until the end of the year, look for losses that we may be able to harvest to offset that gain to make it a tax neutral event. So very aggressive in making sure that we have 0 net short-term gains throughout the entire year. However, if the client has a long-term gain, well, we'll take that long-term gain, and then more towards year end, we'll look to see if there's any opportunities for loss harvesting where we can use those losses to offset the gains. So very aggressive in short-term gains, long-term gains, because they're taxed at the client's most favorable tax rate. We'll take those gains as the manager wants us to take those gains, and we'll look to systematically look to harvest losses at year end in order to reduce that gains recognition. Now, one of the things that we have the ability to do as well is that we have an ad hoc report on the platform that will allow us to show the after-tax benefit your client will receive. So we do that in 2 different ways. The first is from a performance standpoint. So we'll show you what the estimated after-tax benefit is for using the service. And the second is that we'll be able to actually show you from a dollar perspective how much gains we've avoided and how many losses that we've harvested. And then we'll apply a long and a short-term capital gains rate to that, so that we can show your client, Mr. and Mrs. Client, maybe you paid about $2,000 for the service for the year, but we look to have avoided about $22,000 in a tax bill versus not using the service. So it's a great way for us to show what the value of the service is to your end client. Now, here are 6 use case scenarios that we typically see for our clients. The first one is, you may have some clients that just say, you know what, I hate paying taxes. You know what, I worked my entire life, we're investing these assets, I don't want to see significant gains in my portfolio. So and this is a case where we would go in and we'd be, looking at the client's portfolio, try to reduce that tax burden on a, in a regular basis, because what we know is that there are inevitable portfolio changes, right? Whether that is a rebalance from one sleeve to another, whether that is cash in, cash out, securities in, securities out, whether it's a manager making a portfolio update. Anytime there is a anytime there is a tradable event in the client portfolio, it will be a taxable event, right? Whether it's a gain or a loss. And whenever we are trading a client's portfolio for whatever reason it may be, we are attempting to do it as tax efficiently as possible. And what we know is for you as for advisors, you're transitioning or migrating clients all the time. Whether that is a prospective client that you may have coming from another firm that is bringing over legacy positions, or maybe you're trying to transition your book of business from more of a APM or transactional type of accounts to more fee-based accounts in nature. We have a way to try to transition those assets. We'll show you in just a few slides how we can use a long-term capital gains budget to take those gains out over multiple tax years. And it's a way to really show the transparency in how we're going to be trading the account and transitioning accounts over multiple tax years potentially. What we also know is there's other reasons why advisors and clients use this, whether that's responding to outside taxable events. So let's say that your client has a large taxable event. Maybe it's the sale of a business. Maybe it's an outside brokerage account. Maybe it's another advisor that has another part of the client's business investments, and it may be creating some taxable events. Well, if you make us aware of those, we can change the way that we're managing your client's portfolio. And maybe there's a large taxable event, and we can be more aggressive and tax loss harvesting, so we can use those losses to offset external taxable events. We also know that some of the managers may be making changes that we need to take into consideration. And lastly, we've seen a lot of wealth in individual clients that have accumulated concentrated positions, whether those concentrated positions are individual equities or whether they're just a low basis portfolio that we're looking to transition over multiple tax years. So there's multiple reasons why clients are using this today, and I'm going to actually show you how we can help transition assets in just a minute. Now, the second service that we have for the UMA is the values-based overlay. So we've partnered with a company called Sustainalytics, and Sustainalytics is owned by Morningstar, and what they do is they provide us with critical information for thousands of different companies. What this allows us to then do is to build these personalized values screens for your clients. So you may have a client that doesn't want to own abortion-related stocks. They may own, companies that don't want to own, alcohol, tobacco, kind of the traditional sin stocks. But you may have some other clients that are more thematic in nature, right? So they don't want to own, maybe it's fossil fuels or unsustainable farming or Catholic values. So there's other types of screens that can be applied. And what this basically does is it will go through and it does something a little bit different than, say, an industry screen on, say, alcohol. What it's going to do is it's going to look at not just the manufacturers, but maybe the distribution and maybe people that are profiting from the sale of alcohol. So that would be maybe restaurants, for instance. So this is something that we see more and more clients starting to use. And all the studies and the research shows that the next generation, those that are actually inheriting assets, this is very important to them. So I would say at least have a conversation with them. It's a little different than SRI, ESG. It's more values in nature, and therefore it falls under kind of a different classification than the SRI or ESG as well. Now, as I mentioned, we see a lot of clients that are trying to transition assets. So let's take an example here where you have a very high net worth individual where they are adverse to taking taxes in the client's in their portfolio. So they're trying to transition assets. Now think about this, whether it's a prospective client of yours that maybe is coming in that you're meeting for and you're trying to determine, if working with you makes sense, or it could be a client that maybe has a some type of APM type of account or brokerage account with you, and you're trying to figure out how do we transition these assets. Well, I have a tool that is called a proposed asset transition summary. And in effect, what we're looking to do is to take a look at what the client owns today and compare it to what the new asset allocation and that new manager wants your client to own. And then what we're going to do is we're going to provide back a report to you to show you what that taxable implication looks like. So in this case study, we're transitioning assets, and we always want to run one without tax management or at the least amount of awareness to taxes, because what that will do is that'll sell out of all of the legacy positions the client currently owns today that the new manager doesn't own. So in this case, what you can see is the client has to take about $376,000 of short-term gains and about $1.6 million of long-term gains. This is kind of worst case scenario from a gains recognition standpoint, but it's a best case scenario from purely an investment standpoint, because your client's going to own everything that the manager wants the client to own day one of trading. Now, this is a very tough pill to swallow for most end clients, right? Because what this means is the client has about a $550,000 tax bill as a result of transitioning these assets. So what we then want to do is, in working with you as the advisor on the account, we want to determine, is there a way for us to transition these assets potentially over multiple tax years? So in this case, what we're going to do is we're going to establish a zero short-term gains budget, which means that we want to take approximately zero gains every year on the short-term side. And we're going to establish a $500,000 long-term capital gains budget. Now, that's still a huge number, okay? But what we want to do is we want to start to show the client how we have a glide path to unwind out of those non-model positions. And in this case, what we've determined is that if we just do a straight line 500K, that's going to probably take us 4, 5, 6 years to systematically unwind out of those gains each year over the next, say, 4 to 5 tax years. At the beginning, the client has what we call tracking error, this 180 basis points. And what that's trying to approximate is, what is the potential performance deviation versus what the manager's returns are going to look like? And the reason why we have this tracking error is that all of the legacy positions, right, this 1.5 million of non-model unrealized gains here, that is all within the UMA account. So we are actively risk optimizing and tax managing those portfolio, that entire portfolio, which means you as the end client, all the assets are in there, and the client is paying the full fee on the entire account, and you as the advisor are receiving full compensation for all those assets as well. So what that looks like is that we have basically a 9-page report that'll come back and show you, here's what the client's current, portfolio value is, the unrealized gains, both model and non-model positions, how many of the existing positions do the new managers own versus what they don't own. And it gives you great insight as to what that transition looks like. And what controls that gain recognition are the long-term capital gains budgets. We'll also show you what the potential savings looks like versus not using the service. So in this case, as you can see, $376,000 of short-term gains, $1.6 million of long-term gains. The client has a federal tax bill of $550,000. If we were to spread that gain out over multiple tax years, your first year tax bill goes from $550 down to $119, and your potential savings is about $420,000 in the first year. Now, we're not saying we have a magic wand. We're not saying that we can make those securities or those unrealized gains go away. What we're simply saying is we're controlling the type and the timing of those gains over multiple tax years. There is an outstanding liability due, right? But what it also enables us to do is it also enables us to take advantage of future volatility in the market. So if there's a big pullback next year, right? If we were to have taken all the gains this year, we don't have the ability really to offset any of those gains in the next year. But by spreading these gains out over multiple tax years, I'd be able to harvest a bunch of losses next year because we still have those non-model positions in the account that allows us to take advantage of future volatility, offset, those non-model positions in, say, year 2, 3, or 4. So it's a great way for us to transition these assets really over multiple tax years. This is a report that I manage a team here at Envestnet. This is a report that my team runs on a daily basis for, for all of our advisors that we work with. So this is something that you'll become familiar with, in a way for us to help show you that taxable implication, how we can control the gains realization, and really show a client how we can spread these gains out over multiple tax years. Now, the second one that I wanted to briefly show you is this. Let's say, for instance, you do have a client that just wants, is just concerned with the value. So maybe it's an IRA account, and there's not a tax issue there. But what they want to do is they want to invest their assets according to their belief systems. So in this case, the client didn't want to own embryonic stem cell, alcohol, firearms, tobacco, abortion-related stocks. So we can run another quick analysis for you to show you, in this case, if you had right here 5 different equity SMA managers, or 4 rather, I'm sorry, large cap growth, value, international value, and a small mid cap core, we can show you the percent of the stocks that are being restricted in each of the sleeves, the managers, and what it is overall at the account level. And then what we can show you is what's the approximate tracking error in the portfolio. So by introducing, 5 different value screens to the portfolio, we anticipate that the client's return could differ on a first standard deviation from the managers up to about 125 basis points. So it gives you great insight into the potential, variation in returns that the client may anticipate versus those managers. What we've really talked about today is a way for us to, customize these portfolios, whether it's for tax or for values, to really meet the client's end needs. And so this is a great way for us to, come in, show you what the value is, show you how we'd be able to help in a UMA instance, and really show you when the client has, lots of individual equities, mutual funds, ETFs, and we're trying to transition them over to a fee-based environment. This is a great way for us using overlay services to do that. Now, I just want to take a few minutes here and talk a little bit about on the fund strategist portfolios. So for the fund strategist portfolios, we have a way to transition mutual funds, ETFs, individual equities over to a fund strategist portfolio as well. We spent the vast majority of the time talking about UMA, but I wanted to just mention that we do have the ability to have a similar type of experience for those clients looking to move into the FSP or the fund strategist portfolios, which are comprised strictly of mutual funds or ETFs. And we have the ability to transition those assets as well. It's a little bit different because within the fund strategist world, when we're dealing with mutual funds and ETFs, the client may own a very similar security to what the manager wants the client to own. So let's take, for example, where a client owns an S&P 500 from one manufacturer, but the model calls for your client to own another S&P 500 from a different manufacturer. Well, in that case, we probably don't want, and we probably all agree, it doesn't make a lot of sense to sell out of one S&P 500 ETF to take a capital gain to move into another one. So we don't have budgets in the FSP world. We have sensitivity settings, and it's a way for us when we're holding that almost identical security to continue to maintain and hold that legacy position indefinitely and not necessarily have to get out of that position. So it's a little bit different, but it's a great way, again, to transition clients that may be in a brokerage account, an APM type of account, over to a managed account using mutual funds and ETFs in that instance. So with that, Marcus, I'm happy. I think we had some questions come in earlier. Happy to answer those questions.
Yeah, great presentation, Michael. I think this is really helpful for our reps who are looking to transition business from APM or brokerage over to advisory. It's a great service. Envestnet, I believe you guys have $15 billion or more in tax managed assets with this program. So obviously you guys are doing something right there. Just a couple of quick questions. Number one, people who are probably still listening, they're probably wondering, how am I going to present this to a client? Like, how am I going to pay for this? It'll either be 8 or 10 bits, but how do you see advisors have this conversation with their clients?
Yeah, great question, because it is an additional service, optional service, and there is an additional fee for it. So the UMA tax overlay is typically 10 basis points, and the fund strategist is 8 basis points. For new or prospective clients, it's a lot easier conversation, right? Because it's a way to build that into the fee schedule without them saying, "Oh my goodness, are my fees increasing?" So for those prospective clients, it's an easier conversation to have. And what we find, in those instances, the vast majority of advisors are passing that fee along to the end clients, because the end client's who's benefiting from this. For an existing client that may be on platform, that may be a little bit more difficult conversation to have, because because it is an additional service with the additional fee. Either one of two things has to happen, right? Maybe if we can talk about the value of it, maybe the fee increases to the end client because they are receiving a different type of service that will benefit them. In some instances, what we've seen is that advisors take it on themselves and maybe reduce their fee by that, 8 or 10 basis points. What we see a lot of times, though, is that when the advisor explains this to the client in full transparency, explains that it is an additional fee, many times what we find is that advisors kind of split that fee, and they may say to their end client, "Look, this is going to cost me 5 basis points. It's going to cost you 5 basis points, but I believe in this so much that I'm willing to reduce my fee by that 5 basis points and pay for it, as opposed to passing it along to you." So we've seen that many times. That is typically what we see with advisors adding it to existing client relationships.
Yeah, that makes a lot of sense, Michael. Another question we have here is, how often does the team look to trade the portfolio? Is there a trigger for harvesting? Can you talk a little bit more about that?
Sure. So when we think about the tax management aspect of it, it's really anytime anytime there's a tradable event, we are going to attempt to do it as tax efficiently as possible. So whether that is cash in, cash out, securities in, securities out, managers making updates or rebalancing, we're attempting to make that as tax efficiently as possible.
Great. And one last question. Can you talk a little bit more about the tracking error and how you aim to not stray too far away from the performance of the individual manager?
Yeah, absolutely. So when we think about managing for taxes in the client's portfolio, it's always secondary to the investment, right? Your client is investing their money first and foremost from an investment standpoint. So when we're making changes around the edges, we're trying to augment what the manager's doing and not get in the way of that. So it's always first and foremost the investment side of it. But if we can do something that adds some value, in the case of, like, if the manager wanted to trim that position when your client's held it for 11 months and 2 weeks, by holding it for additional 2 weeks, we're going to measure the amount of tracking error that gets introduced, and we can weigh that against the potential savings the client has from a gains recognition standpoint. So always first and foremost, it's about investing. Secondly to that is the tax management, but we're trying to provide a better after-tax experience for the end client.
Thanks, Michael. Thanks everybody for joining. Thank you again, Michael, for just being very hands-on with us, home office. We're very excited to eventually launch this, hopefully during the start of next year. If anyone has any questions about this, want more information, please reach out to me at wealthsolutions@stonex.com. I'll be happy to take questions back from this call. But again, thanks, Michael, and I hope everyone has a great Thanksgiving. Thank you.
Thanks, everyone. Have a great Thanksgiving.